Gold market outlook, July 2026. June marked gold's third consecutive monthly decline in fiscal year 2026 to 27, extending a 4-month correction. The last time gold corrected to these levels in March 2026, it rebounded by nearly $600. Could history be repeating itself? This time, the key variable isn't multiple headwinds, it's the US dollar. If the Federal Reserve shifts its stance, the recent correction could reverse quickly. In the next 90 seconds, we break down what's driving gold and the key signals investors should watch next. June, reset the gold narrative. June marked a decisive reset for gold. After months of record highs, prices corrected sharply as investors repriced expectations for US monetary policy. The correction wasn't driven by a collapse in fundamentals, it was driven by changing expectations. The Fed took center stage. A resilient US labor market, sticky inflation, and new Fed Chair Kevin Warsh's hawkish debut convinced markets that interest rates could stay higher for longer. Higher real yields and a stronger US dollar weighed on gold, pushing prices lower through the month. Markets may be overestimating the hawkish cycle. While markets are increasingly pricing another Fed rate hike, we believe the next meaningful policy move is more likely to be a rate cut. Even if another hike occurs, it could quickly prove to be a policy mistake, forcing the Fed to pivot sooner than investors currently expect. Long-term investors should not change their mind. Importantly, the structural demand story remains intact. Central banks continue accumulating gold and ETF positioning has remained relatively resilient. That suggests institutional conviction has not weakened despite the recent correction. Watch the pivot, not just the data. The key for investors is to look beyond short-term volatility. As expectations eventually shift from tighter policy toward easing, the pressure from higher real yields should fade. Combined with persistent central bank demand and fiscal concerns, the longer-term bull case for gold remains firmly intact.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.